And the contents of this presentation is for informational purposes only. No one at ICLS, including any attorney making the presentation, is rendering legal or other professional advice or opinions on specific facts or matters. The viewing and distribution of this presentation to any person does not constitute the establishment of an attorney-client or other relationship. And ICLS and the lawyers making this presentation assume no liability in its connection with its use. So with that, I will hand it over to Jennifer.
Well, hello, everybody. My name is Jennifer, as was already stated, and today we're going to be talking about those tax considerations you have when starting or continuing to render services for a small business. You know, there's lots of things you have to consider when opening a business, and one of those is those tax considerations and responsibilities that go along with it. We're going to go ahead and talk about some of those today. I do not warrant that this is an all-encompassing statement, or that all of these, you know, that this encompasses everything that a small business may foresee, but I mean, this is what the most common things are. So first of all, there's three types of general business entities when you're entering a business. First of all, there's sole proprietorships, then there's limited liability companies or LLCs, and there's corporations. Each have different things and different requirements. So sole proprietorship is an unincorporated business with owners who pay personal income taxes on the profits earned. They're very easy to establish and dismantle due to the lack of government involvement. You don't necessarily have to get some government sanction for your business or some government paperwork saying you are a sole proprietor. So a lot of times it's the easiest to form. One of the main disadvantages of it is that you don't have protections because it's not government sanctioned, or there's no government involvement, so they don't do a lot of protections for you like they do in the LLCs and the corporations. Meaning that any liabilities in regards to incidences, lawsuits regarding things that happen with the business are basically on the owner. Sole proprietors report their income and expenses on their personal income tax returns and pay income and self-employment taxes on their profits. And we will get into that more later on in the presentation. A limited liability company is a business structure in the US that protects owners from personal liability for debts and liabilities of the company. They're hybrid entities in that they combine characteristics of corporations and partnerships or sole proprietorships because they do have that limited liability section that's like a corporation, but then they're also are taxed much like a sole proprietor or partnership because that income from the business flows down to the owners on their personal on their personal 1040s every year. And then of course there's the corporations, which I know we all hear so much about. It's a legal entity that is separate and distinct from its owners. They file their own tax returns. The owners themselves are not necessarily liable for the suits or amounts owed by the company. The company itself can enter into contracts, loan and borrow money under the company's name, sue and be sued, hire employees, own assets, and pay taxes all in the company's name, as opposed to you personally. However, today we're going to focus on taxation of a sole proprietorship, but a lot of these can also be taken into account in limited liability companies and corporations, in that there'll be some tips of the trade that I'll be giving that can kind of also go for corporations, such as keeping all records and things like that. So sole proprietors report their income and expenses on their personal 1040 tax return that we all have to file as people who make money in the United States. And so you're gonna report it on that personal 1040, specifically on that Schedule C. And you're also going to have to do quarterly tax filings in order to meet those requirements and not be in compliance with the IRS. And we'll get more into detail on that as well. So this is specifically the Schedule C. This is basically a schedule to the 1040, and it's specifically to show the profit and losses from a business. As you can see, it talks about the income, then the expenses of the business, and then comes down to a final profit from the business, which is what an entity is. What you are ultimately taxed on is the profit from the business, not just all the money that comes in, It also takes into account the money that goes out to sustain the business. And so those are where you would see the expenses and the cost of goods sold and other items as well. So to calculate the income that is taxed, so the Internal Revenue Service has the authority to tax the net profit of a business as self-employment income. And of course, that's again on Schedule C, which that bottom line number is then put onto the first page of the 1040. So to find that net profit, you have to take the gross income and subtract the ordinary and necessary business expenses. And we'll get more into that as well. So gross income is the gross receipts of the business less the cost of goods sold. So we need to distinguish between cost of goods sold and ordinary and necessary expenses. So gross receipts are the total amount of receipts or money that comes into the business. So for example, if you are a grocery store, it's that bottom line complete number that are the purchases for the day. So say there was $10,000 that went through that register that came in from customers that day into the different registers of the business. So that's what the gross receipts are. Then you're going to have your cost of goods sold. And using my same example of a grocery store, you're going to have what you paid for all those different items that are on your shelves. That's what your cost of goods sold is going to be, plus your labor, meaning the people who are sitting there checking people out, stocking your shelves, helping people to their cars, monitoring, all those employees that you have. Those are all the labor would be cost of goods sold. So, so again, that's how you get to gross income. And then from gross income, and then here you also see this, I did a close-up of that section of the Schedule C. So you'll see that, it's gross receipts, less any returns, which if you're a business that allows returns, which a lot do, if they're product businesses, you'll have to take into account the fact that you had to pay people back, and you'll subtract that from your gross receipts. And then you'll take your cost of goods sold into account, meaning that the costs of, again, the products, the direct labor for the products and other items. And then you're going to have those other expenses. And those are to be deductible, a business expense must be both ordinary and necessary to the business in order to be deductible. A necessary expense is one that is helpful and appropriate for your trade of business. A lot of times the IRS takes into account what is normal within that industry. While that's not an ultimate deciding factor, and the IRS can't, the IRS can allow other things and things like that, and you can make arguments. They do largely look at what is normal for your industry. An expense does not have to be indispensable to be considered necessary, meaning it doesn't have to be absolutely 100% necessary to be considered ordinary and necessary to be deductible. So it doesn't have to be vital to the business, but it does have to be like ordinary and necessary. And again, here's a close-up of the expense section of that Schedule C. And as you'll see, we're, advertising, that's something that isn't directly involved with the cost of the goods, but you're advertising your store or your product. And again, going down the list, there's lots of different items, including mileage, so tracking car expenses to do work, to go to and from places for work. Contract labor, meaning not your hourly people, but the people you contract for labor. And just depreciation of machinery and things, employee benefits, just all these different items. You go to the other side, you have office expenses, rentals, cost to rent the office space, other supplies such as like the back office of a grocery store. You're going to have printer paper, you're going to have other things that aren't directly related to the goods, but are related to the running of the business. Again, you may have travel for your business and meals and travel for other things, as well as utilities and wages that aren't directly related to the goods. So tips of the trade, tips of being a business owner here. So keep your documentation. You want to keep any and all documentation of any of those items that you want to include in income or subtract as expenses. You want to be able to show those to the IRS if they ever ask for them or audit you. You don't want to be caught off guard and not be able to prove them. Because once they audit you, if you can't prove them, then that makes it a million times harder, if not close to impossible. It's not completely impossible. It makes it so much harder to get the IRS to accept an expense if you don't have the proof of it. So from the get-go or from now on, depending on where you are in your business keep those records. Don't not keep them, and keep them for a significant amount of time after that same year and after you file your taxes, so that you have them in case you're audited several years later, because sometimes it can be a few years later that they audit you. And again, you're still going to want all these so that you do your taxes correctly. So I mean, it all winds into doing your taxes correctly and then being able to prove to the IRS. But you don't want to face an audit without them. That's for sure. And so you want to make sure, that's something I want to stress throughout this, is you want to keep documentation. Now, one also requirement, along with those 1040 Schedule C requirements yearly, you have a quarterly estimated tax return requirement. So all individuals, including sole proprietorships, partners, and S corporations, generally have to make estimated tax payments if they expect to owe the IRS more than $1,000 in taxes for the year. Employees or W-2 wage earners usually meet this requirement not by their quarterlies, but by their withholdings by their employer, and then their employer reports those to the IRS. So that's how a employee W-2 wage earner meets these requirements of their quarterly estimateds. However, when you're self-employed and running your own business, you do have to make sure you file these quarterly in order to stay in compliance with the IRS so that you don't get in trouble. Because on top of that, when you do your yearly return, you're likely going to get penalized for not having done it over time if you owe, assuming you owe the taxes. And failure to file these put you in non-compliance and subject you to penalties if you end up owing over these thresholds, which is common. Here is an example of that estimated tax return paper. There are forms with it that you use to calculate what you estimate to be your taxes, and that's different for everyone, obviously, and you go through it and do that. This is the form that you'll mail to the IRS quarterly, and you'll fill it out, put your estimated amount you're paying, and send that to the IRS. And then when you're doing your yearly 1040, it's going to ask you how much you made in estimated tax payment. So you'll calculate what tax you owe, and they'll take into account what you've already paid in, and then they'll see if you owe anything else after what you've already paid in. Another thing you're going to see in filing your 1040s as a business owner is you're going to owe self-employment taxes. So this is important to think about because this is above and beyond your normal tax that you pay. This is above and beyond the income tax that you're going to pay on the income. You're also going to have a self-employment tax, which is based on that business's earnings. A self-employment tax is collected from self-employed individuals and small business owners who don't pay withholding taxes, or FICA. So basically what you're paying is FICA taxes. So you're paying into Social Security and Medicare. And this, while it may seem crazy and you may not want to pay it on top of the income taxes on a yearly basis on your tax returns, keep in mind this is ensuring that you're paying into these programs. So it'll keep you able to qualify for these programs, because Social Security, you have to have paid into it for a certain amount of time. But if your only income is business income from a self-employed business, you need to be paying self-employment taxes in order to be paying into your Social Security. It is taxed at a rate of 6.2%. And a self-employed worker is taxed both the employer and the employee portions, though on the front page you are granted a credit for that when it comes to how much income you're taxed on. The Social Security is applied to the first $147,000 of income, and your Medicare is taxed on, I believe, all your income, and it increased for 2013 and is only applied to the first $160,200 of income. Now, as a business, even a sole proprietorship, you might hire people either as employees or independent contractors to work for your business, to do things for you, to increase your bandwidth, to increase your profits, which is always a great thing. But that also increases your kind of requirements and what you need to be doing as the business's owner. So there are two general types of hires that we look at and each has their different requirements. So employees, is a person who is hired by another to perform services, especially for wages and salary, and is under that person's control. Generally speaking, this is going to be your employee, the person who you tell what to do, when to do it while they're on the clock as far as business work. In my example, continuing my example that I used in this instance, I used the store example. It's going to be the people you hire to run the registers. It's going to be those people you hire to stock. It's going to be a security officer you hire if you feel the need, depending on where your business is. It's going to be those types of things. So, and then we have independent contractors, and those are people that aren't your employees, but you contract out to somebody to do a portion. I know I use security as employees or labor, but sometimes you contract out to a service, and they're going to be an independent contractor. So each one has their own requirements, and a lot is more often than not, you're going to see them as an employee than an independent contractor, especially assuming you're in California. There's been a lot of legislation lately on who's an employee versus independent contractor. The general rule is that an individual is an independent contractor if the payer has the right to control only the results of the work and not how it will be done. So you tell them, I need this wall painted of my store, but you don't control, or even the color of the paint, but you don't control their hours. You don't control what paint they use, or, all those different things, or how they actually do the painting. You are not an independent contractor if you perform services that can be controlled by the employer, what will be done and how it will be done. So you're controlling what will be done. Your employee at the register is going to be ringing people up. A lot of times you're going to control their greeting. How do they greet customers? Oh, hello, welcome. And if there's a loyalty card, that tagline, loyalty card, things like that. And then you're going to control what they're doing when they're when they're in your presence. What are they going to do when there's no one there to ring out? Are they going to be stalking the little things in front of them? Or are they going to be cleaning? Are they going to be doing whatever they're going to be doing? So these are the employees. You're going to control, pay them a certain wage, whether hourly or salary, and you're going to be controlling what they do while they're there. And again, I went backwards on accident. Okay, so an employee, you're going to have a lot more responsibility because they are kind of under your control when you hired them to do a job. So some things that you need to keep in mind from an accounting tax standpoint that you're going to have to do is, generally speaking, you're supposed to reimburse them for job-related expenses that they may have done out of pocket on your behalf, and you need to pay them back. This can include things such as mileage, postage. They pick something up from you at the store on the way to work. You pay, for the business, you pay them back for it. While yes, you are responsible for paying for the items, that's part of being a business owner, and also you are going to be allowed to use those expenses in your expense sheets for your business. You're going to be able to write off those expenses at income tax time, which means less income. You're going to be responsible for federal and state payroll taxes. So you're going to be responsible for keeping the books for that, keeping your own books and keeping that payroll. And so you're going to be responsible for taking that percentage of FICA, state, city, whatever taxes are where you're located, and holding those on their behalf and giving them those statements, whenever you pay them, that said how much you took out, and then be remitting them or giving them to the IRS or the Franchise Tax Board, who is the state entity in California, or the city, wherever you are located, whatever those requirements are, you're going to be required to, and then you're going to be required to monthly or quarterly give those to them. And then, of course, you're going to be required to provide that W-2 by the end of January every year. You're required to give that W-2 to your employees so that they can file their own 1040 tax returns as an employee. This is an example of a W-2 form that you have to provide for your employee. Again, it's going to have your information, the employee's information, how much they earn, what you withheld throughout the year in income taxes, Social Security taxes, Medicare taxes, everything like that. And as you can see at the bottom, I'm sure a lot of us have seen W-2s, that'll be where you include the state and local information. Here is also your 941 SS, which is your quarterly return for employers. So you're going to send this into them, fill this out saying, okay, this is how much my employees made. This is how much I withheld in all of these different categories, Social Security, Medicare, federal income tax, and here's your check. And so that's what, and again, you're just going to have to do that quarterly every year so that you're remitting those amounts. And then of course you're going to tell your employee what you did so that they have records as well with their W-2s. Again, so now we're going to talk about those responsibilities to an independent contractor, which are much, much less than those for an employee. And again, you're going to have that 1099 that you have. So instead of W-2, you're going to have a 1099. And that 1099 is going to list everything that you paid them. And so that's what you're going to list. You're going to prepare that, provide it to the independent contractor, and file it with the IRS. You're also, this isn't common practice, so don't worry if you don't do it or don't want to do it, but there are times where it's agreed that an independent contract, that you may take a little bit from what you pay them so that they can keep it withheld for taxes. That's not a common practice, but if you do, then you're responsible to do that as well. But here's an example of a 1099 miscellaneous. Again, it's going to have your information as the payer because you paid them an amount, then the recipient's name, which is the independent contractor's information. Then again, it has all the information. It's either going to be other income or non-employee compensation if they're an independent contractor for you, though there are other sections that may be applicable depending on the kind of business that you own. And prepare. How do you prepare for an audit? So this is a big thing. And this is what all I said before is preparing you for is an audit. So you want to, so the IRS randomly selects taxpayers for audits. They call it random. I don't know that it's always completely 100% random, but they call it random selection. So they randomly select people for audits, and those are, and you're going to be notified via a letter from the IRS that you're being audited. The IRS, whether it's an audit, whether it's collections, whether it's anything, their first conversation with you will absolutely never be via the phone. They will never just call you. So if you get a call and you have not had any contact from the IRS whatsoever, and like, oh, we're the IRS, you owe us money, it's a scam. The IRS will never, ever, ever just call you out of the blue. They are required to mail you letters. In fact, unless you're really getting into the nooks and crannies of an audit or the nooks and crannies of a tax court case or anything like that, generally speaking, you're not going to get a call from the IRS. They're just going to keep doing it by letter. Again, these are generally conducted by mail, but may involve in-person interviews on rare occasions, especially businesses. Though again, a lot of times it's by mail, but sometimes with businesses, they do want to see the business and other things. Unfortunately, as I stated, it's supposed to be random, but businesses are more common than the general public to be audited. So your sole proprietors are very commonly audited. And again, I know we've been talking a lot about sole proprietors, but keep in mind these audit tips, these bookkeeping tips that I've been going over, they're all applicable to all the different types of businesses because any of them can get audited and you want to make sure you have all this information. So what do you do if you're going to be audited? First of all, do not ignore an IRS letter, whether it's audits in specifically, whether it's anything to do with your 1040, you do not ignore the IRS. You want to respond in some form or fashion. Now, yeah, I get it. They're saying you owe money and you legitimately owe, you can't pay. Okay, but don't ignore them because that just makes the problem bigger. There may be ways to resolve that with them. There's different, and that's a totally another conversation, but don't ignore them. The sooner you talk to them, the more options you have to resolve this issue with the IRS, and the more likely they are to work with you because you haven't been ignoring them. Again, preparation is the theme of the day today. You want to be prepared to file those, to create those returns, income, expenses, and all that. You want to be prepared in the case of an audit. So again, preparation, documentation, the keys to the day-to-day. So if you're claiming the expenses, you want to have that little piece of paper that says, yes, I spent this money, whether it's receipts, travel logs, bills, bank statements, check, written, canceled checks, whatever you have that shows you paid that money, you want to keep and put it in a little safe place until several years after you filed your return, so that if it comes time to an audit, you can look at that auditor and say, here you go, here's my proof, accept it. And that makes it go smoother and more likely to have acceptances if you have everything ready, prepared, all of those things. You want to keep them organized so that you can legitimately say, okay, these are the ones for this, and this, and here you go, IRS. So assume it's an audit, they send you the documents, and you want to look at what is being denied. So you want to review that document. And I think okay, so this is a sample of an audit report. So an audit report, you're going to have the different areas of what they're denying. In that case, they deny pretty much everything, so I'm not going to continue to show it. But you want to see what they're denying, get all your records for each item that they're denying, and provide it to them. That way, it's done, it's over with, it's good. So if you, for some reason you didn't keep that documentation, or you don't think you have it, think in your head, you may be able to still obtain it. So think about things. So who did you pay? Who did you actually give the money to for this product, this service, this whatever it is you were paying for this expense? Who did you pay? They may have copies of the fact that you paid them. They may have a receipt or be able to provide you with a receipt. So that's a way to obtain it. Another is, how did you pay? Did you use a check? Did you use a credit card, debit card? Those items would be on those would, if it's a check or a credit card, it's easy to go to your bank statements and get that check, get that line item that you paid the credit card. And so those are easier to obtain. The bank statements, while good, are not my first choice. Neither are checks, because now it'll show who you paid, and that could be helpful. And a lot of times they do accept them. But there are times, especially when it's a commonplace, say you're buying a product from Home Depot or Lowe's or another grocery store or Walmart, just having it say, okay, I went to Walmart and spent this much money, may not be enough for the IRS. They may want an itemized receipt that says, these are the items I bought, that kind of shows that that's what you spent the money on, and kind of correlates it to your business versus personal. So again, receipts and invoices that do itemize are always first, but if for some reason you can't, backup is to get these checks and bank statements that'll say those amounts, so that you can at least give them something, and hopefully they'll accept it. But again, it does make it a little harder depending on the vendor. My advice to any new business owner is going to be to keep things separate. Keep a business account and business credit cards versus personal account and credit cards, because it makes it easier to substantiate that it was business versus personal. Also, especially if you have to go back to those bank statements, because you're going to say, well, this was the business account and this was paid from the business account. It wasn't paid out of my personal funds. So keeping it separate is not 100% necessary, but it makes things easier for bookkeeping purposes as well as proofing purposes. Another thing that is common with our clients with Schedule C issues is they'll come to me and say, I'll say, okay, well, I need all your receipts. I need all your proof. Oh, well, we already sent that to the IRS when they asked for it. I don't have it anymore. don't fall into that, because later on that one department is not necessarily going to send everything to the other department. That other department's going to go, well, I don't have it, so there's nothing I can do. You want to always have a copy. So my recommendation is to make copies of everything and send the copies to the IRS. Don't send originals, because you're going to want to be able to substantiate and send in to everybody. And you want that comfort that you have your own proofs and copies, that if you're in a meeting with the IRS, you can flip through those and go, well, okay, well, you're forgetting this. I sent this to you, but here's this, look at this. You know, you want to be able to in the future still have it and not count on the fact that the IRS will give it back to you. Because trust me, they lose stuff. Again, this was my other caveat again and again. Let's keep documentation. I wanted to put it again because this is so important. You know, so again, you want to provide these, and in doing these returns, you're going to be doing this Schedule C that we talk about. And so you're going to be wanting, you know, you're going to want to have what's all the money that came into my business this year. What is the total amount? Because you're going to need to be able to put it on this return, or have your accountant put it on this return. So you want to keep all those documents about that. Again, having a separate bank account helps with that, because then you could say all my money was deposited. So what were my deposits this year? That helps. Though I know sometimes sole proprietors put their own money in from their personal as part of like owner's money put in, and that has to be distinguished from actual money that was put in from the earnings of the business. But it's helpful to have the own accounts for that as well. So we want, and then of course, again, you want to keep proof of any returns that from your business and any money you gave back, and that's going to come back out of the receipts because you had to return or refund the money. And then cost of goods sold, again, what did it cost me to put all those items on the shelf? What did those items cost me? And what is it costing me to have that cashier or that stock boy? And then of course, again, you want to keep the proof of all these expenses. And so again, when it's tax time, either you alone or your accountant, depending on your comfort level of doing this. And I know once you start a sole proprietorship or your own business, it gets a lot more complicated to do your returns on your own. And so depending on your comfort zone. And then again, you get down to that net profit of the business. And that is what you are going to be taxed on at the end of the year. That's going to be what you're taxed on. That's going to be the number that they're going to use to determine self-employment taxes, everything like that. So you want to make sure this is complete. You're accounting for all your expenses, but you're accounting for all your income as well, in case they find out, you want to be as honest and truthful as possible, including all your income, but also including all those ordinary and necessary expenses. So back to ordinary and necessary for just a second. You want to consider ordinary and necessary. Back to my store example, it's going to be ordinary and necessary for you to maybe have a cleaning crew come in and clean the store every week or every 2 weeks, or however often. Or it may be ordinary and necessary to pay someone to come in and do inventory every quarter. But is it going to be ordinary and necessary for your business to, as a store, to buy a race car and be part of that? No, that's not going to be an ordinary necessary business. And that example comes to mind because that was actually an example with the client. So that actually is a true life example. Not from a store, but it was a different kind of business, but it was still extenuated. So you want to include all your expenses, but keep in mind that the more extenuated, the more they might bite back at you. So you want to make sure you're including everything you can, but be prepared if something seems awful to be able to explain why they're ordinary and necessary. All right, so I think we kind of discussed what your tax requirements are going to, what you're going to be facing as a business, or are facing as a business as far as taxes are concerned. Do we have any questions in the chat?
We actually don't have any questions in the chat. So if anybody has any questions for Jennifer, please put them in the chat, or you can go ahead and unmute if you would like. to ask the question? Oh, here we go. We have a question from America. It says, any info on state taxes for LLC or single member LLC?
Our organization does not deal with LLCs, which is why I limited my scope to sole proprietorships. But again, those LLCs, it's a trickle down taxation, meaning you had to do a return for the LLC, but then its profits are then trickled down to the members or the owners per rata of their share of the business, and that will be put on the 1040. So it is slightly different, but the fact that you should keep, what you need to keep track of, and the fact that it's income versus expenses, all of that is going to be very similar with an LLC than a business. And with the state, it's pretty much, with the state of California anyway, whether it's an LLC or a sole proprietor, which is what I'm concentrating on today, you're going to be facing the same kind of forms and the same kind of information you're going to need to give the state, if the state as well.
All right, we have a hand up from Diana. So I'm going to see, oh, maybe we don't. I don't know where it went. Where did it go?
Diana, feel free to unmute yourself.
Oh, there she is.
Yes. Yes. Hello.
I can
Hello.
hear you better now. You were echoing a minute ago, but I can hear you good now. Yeah.
Okay. I have a quick question. So right now my business is just myself. I'm looking at maybe bringing in maybe contractors to teach one class a month. Now they told me that they're 1099 to 1099 them. How do I even get started with that? Hopefully it's an appropriate question.
No, I mean, it goes back to the discussion a moment ago for your responsibilities to independent contractors. Now you need to keep in mind, depending on how much you're controlling them, there's that distinction between employee, independent contractor. But if they're doing independent contractor, then yeah, you would prepare what's called a 1099, and I brought it back up on the screen, the 1099 every year. And where you would basically tell the IRS how much, give them that person's information and social security number, and usually it's going to be under non-employee compensation, and you will just basically mark how much you gave them in that year. And you have to keep in mind, everybody, that you do have to 1099 or W-2 people in order to claim it as wages or salaries or contractor payments on your own tax return. So in order to say, I have wages of say $50,000 that you want to deduct from your income, you have to actually give a W-2 or a 1099 to people saying I've paid them that much money.
Is there an amount, what if it's a one time for, I don't know, say $30, I would have to report that? Or is it over $200? Is there an amount for reporting that wage, that information?
I would need to confirm. I know there was a point in time that it was over 5, but I know they're being a little more 500, but I know they're being a little more stringent on the 1099s and payments of any form, whether it's electronic or otherwise lately. So I would need to double check. I haven't double checked that in a little bit, but at one point there was a $500 limit. I mean requirement.
Thank you so much.
To make it required, not that you couldn't file it for less than a requirement.
Okay, thank you.
All right, we have 2 more questions in the chat. First, we have from Nita, is there a minimum or maximum net profit necessary to do the quarterly filing, 941, etc.?
So those are 2 different forms. So the quarterly estimated taxes, the rule is that if you think you're going to owe more than $1,000 to the IRS at the end of the year, though that's hard to predict. So doing quarterlies aren't the worst thing to do, especially if you're unsure. They do come with a form where you can kind of put in your income or what you make in a quarter and kind of the expenses and kind of estimate. And if you're If you're off completely, there's not a big penalty if you're too far off, but there is if you really were supposed to and didn't. So erring on the side of caution, maybe estimateds aren't the worst, at least doing the form for yourself and seeing what you think or what you legitimately estimate it to be. Now, the 941 is one that you have to absolutely 100% do no matter what if you have employees, because that's the one where you're giving them their portion of FICA. And so for that, for a FICA and their income taxes, so you're withholding from their paychecks. So that you absolutely 100% have to do quarterly no matter what, no matter the amounts.
And then we have
Okay.
one last question here. It says, can you 1099 a business?
Yes. You can 1099 a business or individual. If you are 1099ing a business, you'll put the recipient will be the business, but the recipient's taxpayer identification number will depend on whether they're a corporation, an L or a person or an LLC or a sole proprietor. If they're a sole proprietor, you're going to put that person's social security number. But then if they're doing, if you're paying them as like a sole proprietor business, you can always put the business's name here, but you're going to put their social. But if they're a corporation or an LLC, they're going to have their own federal tax ID number for the business itself, and they can give that to you to include as the recipient's identification number. Because they filed their own tax returns for that business, and so they've been issued a IRS ID number for the business.
All right, do we have any other questions? I'm not seeing any. I am going to put the link for the registration for our next webinar on July 12th on entity selection and early business formation. Actually, the link might not be working there in the chat, so I will email you all the link if you were registered for this webinar. Jennifer, do you want to put it on the last slide so they can contact ICLS?
Yes, so we're great. So keeping all this in mind, if for some reason you need help, need advice, need assistance, because you're having issues with the IRS or being audited, don't hesitate to, you have some options. You can go to the Taxpayer Advocate Service, who is your voice at the IRS. They're an advocate for you there and they can help. But then there's also, there's irs.gov that has a lot of good frequently asked questions or information. That's where even I will go first to get information about an issue that I may need clarification on or updating on. Or you can always call ICLS as well, whether it's us or the Small Business Clinic. These are our contact information at ICLS, ICLS.org, or also 888-245-4257 is our intake line to call and get connected to an advocate.
Yes, if you want to contact the Low Income Taxpayer Clinic or the Small Business Clinic for any questions, please call that number. That is our intake line. That is how you apply for our services. We are only able to help eligible residents of San Bernardino and Riverside counties. So please call that number and apply if you're interested. And please come to our next webinar. And thank you so much to Jennifer. That was wonderful. I learned a lot. And I hope that everyone else did too. And I hope that everyone has a great day.